Welcome to another episode of Break Away from the Rat Race. And today we have the pleasure of speaking with Brad Shepard. Brad has been involved in commercial real estate for over 20 years, along with his own rental portfolio and a handful of house flips. His experience includes development and management of retail and hospitality space and raising capital from domestic and international investors. He's been exclusively focused on capital raising for commercial syndications since 2017, and his website is sugarhouseinvestments.com. Brad, welcome to the show.
Thank you very much, Eric. I'm excited to be here.
So tell us a little bit about kind of like your journey. How did you decide to, why choose commercial real estate and syndication? Why not there's so many other ways to make money in real estate or in the world in general. So why choose commercial real estate?
I do have a little bit of a long and winding journey, so I'll give you the short version. But you're right. That's one of the great things that I love about real estate. There are so many different ways you can make money in real estate. And there are some very brilliant people in real estate, of course, but it's the place where I see like people of average intelligence have the best shot of making a good amount of money.
I call it the great equalizer. I mean, it doesn't really matter. It's very simple business model. It's pretty easy to understand.
Exactly.
The numbers are simple, right?
At its core, I mean, sure, you can get into some, complicated calculations, but at its core, it's really simple. You've got a place that people, you have an attractive place that somebody needs to live in or, run a business out of, and you charge them money for doing so. And that's it. So it's nuts and bolts. It's pretty simple. So I actually went to college with a finance major focused on commercial real estate. So I did my college internship with a large commercial real estate developer and financier up in Seattle. It was a blast. So that summer, they basically gave me a spreadsheet to work on for a summer, but I got to go out to see different projects that they were working on. We're wheeling and dealing in skyscrapers and shopping malls domestically and internationally. I had a blast. I came back from that internship and life took me a different path. So I ended up not pursuing that path as a full-time career right out of college, but I stayed with a little small company in the town where college was based. And as that company progressed, we actually had the ability to start doing some real estate deals, started doing some vacation rentals. And this is back before there was such thing as an Airbnb or VRBO. We had an opportunity to build a hotel, and we had to raise capital to do so. As part of that hotel, there was a hospitality and cafe. Beyond the hospitality, there was a cafe and retail element to it as well. And so when I left that company, that was after 9 years of being with them as a partner there, we moved to Austin, Texas. That's where I started doing some more of the traditional active deals like fix and flips and wholesales. And I started doing that and realized, man, this is awful. I really don't like this. I don't like this idea of yellow letters and knocking on people's doors and chasing foreclosures and dealing with the contractors and picking out paint and tile colors. And so the light bulb finally dawned on me again, like, okay, commercial. So I started looking at the idea of syndicating my own deals and knocking down some large apartment complexes. And in that process, as I started building relationships with brokers and operators, I learned of this need for capital raising, people bringing dollars to these commercial syndications. Rather than competing with these operators, I could buddy up with them. And so that's where I really latched onto in 2017 and have found a great an avenue for me there to participate and work with experienced, successful operators and bring in retail investors who are successful in their own right, running their own businesses, running their own professional services operations, whatever they're doing, who want to participate in real estate but don't want the hassle of the day-to-day operations. And so bringing those two parties together is where I sit, and it's been really fun. And commercial syndications, again, it's an easy get. Apartment complexes, we've all lived in one. It's easy to understand. Storage sheds, we've all seen them. If we haven't used one, you get the idea. So these are pretty easy concepts for the average retail investor to understand, and it's been fun to see their increase in popularity over the last several years as well. So that's where I sit, and that's a little bit of my winding journey.
Yeah, I mean, this is that's why I call it like the great equalizer. I mean, this is like with You don't need to be, the smartest light bulb in the town to figure it out. I mean, it's a house or it's a building, and you rent it out. So I think this is great. And on top of that, it's also a very good investment compared to all the other alternatives. I think, especially in this environment with high inflation, and you're comparing with stock market, for example. I was looking on your website that you had an article comparing stock market investing, the challenges there, and comparing that with real estate investing. And maybe you want to talk a little bit about that, about kind of like how the numbers work out a little bit better in favor of, I would say a lot better in favor of real estate.
Where in real estate, we talk about that equalizer. I mean, that just doesn't exist in the stock market. When you've got these companies that spend billions of dollars to be, when they're talking about nanoseconds and who has the fastest fiber optic connection to the trade center, because they're and all their trades are done automatically via these bots that are analyzing worldwide data real time. The average Joe, I mean, you just can't compete against those firms. And so then we're told, just go buy some index funds, right? And that's all you got. And when we've seen all this volatility over the last couple of years of these meme stocks, these astronomical rises that get driven by Reddit forums, and yeah, man, if you can catch one of those waves, great. But man, talk about speculative. The margin calls, the short squeezes that were happening, and then over the last year, I mean, I do have a little bit of money in the stocks, and it got hammered just like everybody else. And I just do index funds because I know I don't have any advantages there.
That's because you're smart. Yes. That's what Warren Buffett said. He said, if you think you know how to pick a stock, then you don't know how to pick a stock, because nobody knows.
And so because you don't have any advantages, you just index funds make the most sense for the average investor. But then you're at the mercy of that market, where a meltdown, a world war, or an international conflict on the other side of the world has a massive impact on my portfolio, which is bonkers to me, as opposed to a real estate complex at a physical asset where I can drive down the street and touch it. People still have to live there. They need a place to keep their stuff, and inflation is actually can be beneficial to that asset class. It's a lot more even though it's passive, it's still a lot more in our control. It's in our backyard. It's something that worldwide forces, they can impact us in the interest rate conversation, but they're not to the same level that can wipe out half of your 401k value 2 years before you were planning on retiring.
Yeah, and that's what I'm afraid of, is people that were planning to retire this year, and then now they find that their 401k has shrunk 20 or 30% or even more, and just like, okay, well, I guess I have to work a little bit more, or
right. So that volatility, that unpredictability, we had an amazing bull run the last 10 years, right? But if unless you sold at the top, you got hammered like everybody else. And that just doesn't happen in that same kind of massive way when we're talking about solid cash flowing operational real estate assets.
And there are ways in the stock market to make money in all kinds of situations. You can make money on the way up. That's the easiest one. That's why people were investing so much in the last 10 years, because the stock market didn't matter where you threw your dart, it was going to go up. So everybody feels like, oh, I'm a stock market genius.
Everybody, right?
And now on the way down, you can still make money on the way down, but you have to know how. And this is kind of like where the lack of knowledge, the lack of information is critical here. And most people don't have it. Most people they just bought the stock, and it went up and they made money and they pay their capital gains and they're happy. But there's a lot more to it than that.
It really is. And the person who's working a typical 9 to 5 and they just put money into their 401k or their IRA, they could go watch some YouTube videos. They could go get some books and learn about how to do margin buying, option buying, shorting. But that's just, it's asking a lot for the average investor who doesn't, that's not their specialty. That's not their primary interest. So yes, you can make a lot of money in a down market, But it does take specialized knowledge where
Exactly.
beyond what we typically would need in a real estate discussion.
Exactly. So I think exactly in the stock market, I mean, it seems pretty simple. You buy, oh, I like this company and blah, 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 and I'm just going to buy the stock. But it's a little bit, it's more than that. And you have to have more knowledge in order for you to make money on the way up and on the way down and managing cash and all of that. As opposed to real estate. Real estate is still very simple, and the numbers are very simple. There's no options. Well, there are kind of, but there are no real like call options or put options or anything like that that you would do with these assets. So it's pretty down to earth, pretty simple. And like you mentioned earlier too, like you're in control. You're fairly in control of what's going on. You have to deal with, some external variables like inflation, interest rate, and all that kind of stuff. But it tends to be pretty localized and something that you can act on to make it better sometime.
Right. And that localized aspect, sure, global forces can impact us in those interest rate discussions, overall job market healthiness. But when we pick our markets that we buy in for very specific reasons, these are strong job growth, population growth areas that aren't going to be impacted by a massive outflow of population or a massive layoff scenario that can really significantly impact vacancy. And so that localized aspect where you can be really specific in where and intentional in where you buy these assets allows you to be allows a high level of insulation from the global forces out there that are so impactful on the stock scene.
So in your commercial real estate, the type of asset that you chose that you're investing in or raising capital for are the retail and hospitality, like hotels, motels, and that kind of stuff. And does that include also like restaurants as well?
So just to correct that a little bit, most of what we buy now, and in my experience in the last 5 years, has been apartment complexes.
Oh, okay. Oh, so okay.
Yep. So I've had experience, when we built that hotel and renovated a couple other hotels that included some, retail and food elements. Those were fun, but I realized and learned those are highly involved operationally, and a little bit more volatile as well. Apartment complexes now is my primary focus. We also have deals that we do in self-storage and mobile home parks. So those are our three primary asset classes.
Okay. So that's interesting. Yeah, because my next question was kind of around like, how's that going? How's the retail space going, and how hospitality as we head into high inflation, potentially a recession, and all that. These are the things that people are going to cut. But okay, so self-storage, mobile home parks. These are very good in apartment building. So let's talk a little bit about kind of like maybe mobile home park. We haven't talked too much about that, and self-storage. These two are kind of a little bit, I would say, kind of like people don't talk too much about that. So what are kind of like the specific characteristics of these types of asset class? Why are you attracted to self-storage and mobile home park?
Yeah. So it's, for our first time investors that are placing money in a syndication, it's a new concept for them, a new investment class for them. We see that most of them will lean towards the apartment complexes, but after they get comfortable with this idea of investing in private real estate opportunities as opposed to the stock market, we expose them to the mobile home park opportunities and the self-storage, and show those potential returns and why we like those asset classes. These end up being really popular with our investors. So talking about inflation for one, inflation means rental rates go up. In an apartment complex, you have the opportunity to reset rents once a year. Generally, when that lease expires a year, most renters have a year-long lease. At the end of that lease, you have an opportunity to increase the rent. In self-storage, that's monthly. So you can price real time based on what's going on in that market around you. And so in an inflationary environment, right, like what we've got right now, we're seeing our rental rates on our self-storage portfolios increase on a monthly basis, where we're able to keep pace with that. And so that rental rate reset window is really attractive for self-storage. And then both for self-storage and mobile home parks, a lot of attention had got driven into the apartment complexes, and it's coming into self-storage, but it's not there yet. It's still a market that's, I mean, the last number I read was something like 75% of those self-storage properties are operated by mom and pop local investors. It's not very institutionalized. And so you're finding these deals where people are running these, really nice, really well positioned. I wouldn't say nice, but well positioned as far as their location properties. But they're doing it off of a notebook. I mean, you'd be lucky to find if they have an Excel spreadsheet. I mean, they're doing literally paper receipts and collecting cash and checks every month and chasing down renters. And so you get an opportunity to
they're probably living on site as well, right? I mean,
yes, you see a lot of that as well. An owner operator living right there on the property. And so there's so much efficiency upside to go buy a property like that, paint it, systematize it, give people the opportunity to rent, to lease and pay their rents without ever meeting in person. Which is amazing. And so you can increase the operational efficiencies dramatically with those types of properties.
The thing too is that the self-storage too, you have to finding the rates is a little bit for apartment buildings. I mean, I can go on Rentometer and I can find kind of like all the, it's pretty easy to find what the rent is around for and what I should rent my apartment for. But for self-storage, it's a little bit more complicated. How do you do that?
Yeah, it really is. You're running, you've got, this property that's got 200 units. We're always keeping track of what the competition is doing, what the inventory and availability is like around us. But we're playing with those rates on a regular basis. We're never shooting for 100% occupancy. 100% occupancy would mean we've priced it too low. So you're aiming for this 95% rate, and that gives you this occupancy rate, and this gives you these units to play with every month. Do we go up $5? Is it taking us too long to rent these ones out? And then you can adjust on literally on a monthly basis to see how these how the market is responding. So it really is market driven on a real-time basis.
So would you say that this is a little bit more active management that you have to do on these properties compared to an apartment building?
In a sense, so self-storage is a little bit more active, but again, you can we've got these systems in place where you can lease this property, access it, pay the monthly rent without ever meeting anybody on site. And so when it comes to an apartment complex, of course, everyone wants a tour. If the toilet doesn't work, it's very personal. If there's a little whatever, it's any little issue, that's people's lives and comfort, and so you've got to deal with that quickly. But it's so there's kind of give and take.
That's right. Sure. So I think on the operations side of it, I mean, definitely you can automate, especially when you take it from a mom and pop shop. There's a way to automate a lot of the process for leasing. You can give them access remotely. They can say, oh, I want to have this locker. You can set up the payment and all that kind of stuff remotely without ever talking to them, seeing them and whatnot. So this is great. This is definitely great. On the other hand, I was thinking in terms of management of the rent, occupancy, and all of that. It sounds like it's a little bit more like almost like a more like a market. You have to kind of like a very competitive market where you have to constantly look for what's my competition doing, what's my rate doing, and then kind of play around with your rates on a regular basis.
Right, and a lot of that can be automated with the software. But it is you definitely got to keep tabs what's going on in the market. The only property we've seen that struggled was suburb of Atlanta, and when we bought the property, there were no other self-storage units around, and within 6 months of buying it, there was some bigger players, some of the names that we all have heard of at this point, decided to come in and build some properties, and all of a sudden rents collapsed in that market. And so those are things that can impact us when all of a sudden there's a massive influx of capacity. So those are the things that we're watching for and looking out for. But it is really constantly keeping tabs on what's going on. And again, that happens in the apartment complexes as well,
Mhm.
because those rents are, in response to occupancy levels and market competition. What's the going rate in this neighborhood? What employers have opened up or laid off, and those things. So it is.
It's just a little bit slower, it seems, than self-storage, which seems to be more active.
Yeah, and in some elements, I'll say there's some give and
Okay.
take.
Yeah. No, that's fair. And then the nice thing about the self-storage too that I've heard is that you can also offer additional services. I know some people are doing like truck rental, they're doing packing,
Right.
they're doing shipping,
Yeah.
and they offer all these services to their customers.
Yes, so you get those ancillary services as well. Much like in apartment complexes, you can make some decent money off of the vending machines, the laundry machines is what I meant to say there. In the self-storage side, yeah, having the U-Haul trucks and the boxes and those moving services can be really lucrative as well and help with cash flow.
So let's talk about the mobile home park. So this is a space that I looked at a long time ago, but I never really pulled the trigger on those things. I decided to start with single family rentals and then apartment buildings and all that. So tell me more about that space. What are some of the nice characteristics or the pros and cons of mobile home park compared to apartment buildings?
Yeah. So again, it's the vast majority of the market is still run by local mom and pop type operators. I mean, we say mom and pop, but it just in that sense, just mean again, just people who
Yeah.
have not updated systems. They're running it off of their their yellow legal pad kind of a setup. They generally have we see a lot of these the land is in really prized prime area. And the stuff is built up around them, so they're sitting on this nice land. So one, the land itself is valuable. Two, the operations of it are really simple. We generally are the renters have they're bringing their own trailer. We're not looking to be in the business of owning and renting the trailers themselves. We just want to rent the space, the piece of land set up on.
Yeah.
And so we're providing the property and the electrical and the water hookups. And from there on out, it's pretty well hands off. We've got on-site teams that are going to go and mow the community areas, and take care of the general landscaping of the common areas.
Mm-hmm.
But other than that, it's really pretty simple to run. And
Yeah.
these are very stable tenants. They don't move. It's a heck of an ordeal to move a trailer. And so they find a place they like, they put that trailer on there and they stay put. And so they're very, again, stable occupancy type properties. So it's those can tend to be a little bit more passive and predictable, stable, and buying these deals in these you don't have a lot of these being built anymore. Cities don't really like approving these properties, so there is limited supply.
Yeah.
But a lot of them were built decades ago, and since then nice neighborhoods have been built up around them. And so again, there's a long-term aspect to these too, where there's could be opportunities for future development too.
Yeah, when I lived in San Francisco Bay Area, I was getting interested in mobile home parks and all of that, and I was just like, then I started looking around, and they had mobile home parks in like prime land, prime location, right there in Silicon Valley, close to the ocean. And I was like, oh my God, that piece of land is worth so much money. It's unbelievable.
Yes.
They've been around for so long. And then you're right. I mean, other developments are kind of happening around it, multi-million-dollar houses close to a mobile home park.
Right.
It's phenomenal.
It really is. I mean, so I live in Boise now, and we see it here as well. I mean, I don't know the last time there was a new one developed here in town, but yeah, you go downtown and right there, and just outside of the skyscrapers, there's an RV park and a mobile home park.
Wow.
We moved here from Austin. Right there next to Zilker Park is a pretty bit large RV and mobile home park.
Yeah.
It's incredible. And, that just the land value there itself is gets you salivating a little bit.
Yeah, yeah. When you don't think about it, I mean, you just or when you start looking at a particular space, a particular investment, and then you see it everywhere. You realize, wow, this is everywhere. You never saw some of these spaces, and all of a sudden you realize that they're there. They were there all along.
Yes.
So it's kind of
So
interesting.
those can be really lucrative, and
Yeah,
I would say we haven't done as many of those deals. They are a little hard to find. With our investors, they wonder, well, would I live there? Is that the kind of stuff do I want to put my dollars into? So it's there. Those haven't been as popular for us as self storage and mobile home parks.
yeah,
But we've done on the deals that we have done in that space. We've done really well by our investors, and or
yeah.
definitely will continue to pursue those opportunities.
So, Brad, if someone is interested, is starting to they like some of these spaces, maybe they like self storage, maybe they have like mobile home park, or they more like they just knew they want to get started in apartment building or something like that. So, how do you recommend that they get started doing that?
Yes, I mean, I guess the first question somebody has to ask themselves is whether they want to be the active operator or they like the idea of being the passive investor. Is that's number one.
Yeah,
It's all these things that we've been talking about, all these details, and the watching the competition, the monthly lease or yearly resets. That's all handled by the operator and the on-site property management.
yeah,
Behind all those teams are all the passive investors who simply put money into the deal and will reap rewards from having participated, and who will never have to make a management decision or an operational decision for the life of the project.
yeah,
So it really is, first determining where you want to sit. If most of these deals are open only to accredited investors. Some of them are open to non-accredited,
mhm,
but it's these people who have got money already accumulated, ready to invest. So they're busy. They've done well in their own professions, and
yeah,
now they like the idea of owning a real estate, but don't want to deal with the operations of it. So
mhm,
the passive role can be really attractive. Um, and I'd say in both scenarios it's even if you want to go the active route, which was what I first intended to do.
yeah,
I connected with an operator there in Austin. Actually, it was Dallas based, but we met in Austin, and I participated as a limited partner, so passive investor in one of his deals because I wanted to learn how do these things work. I wanted to see the presentation, I wanted to see the operations, I wanted to see the communications,
yeah.
and so I went in as a did the minimum investment on that deal. I learned a lot from that deal, and it's it's the only one of my passive investments that went horribly wrong.
Oh,
My very
you
first one.
learned a lot.
But so many valuable lessons learned, and
Yeah,
so I'm
yeah,
able to take that as I'm meeting with potential investors, explaining why we choose the markets we do, the operators we do, the
yeah.
deals that we do. But it was so valuable to me to have that limited partner passive investor type of experience even before I started looking at potentially going the active route.
Yeah.
So that's one where I consider my value add is I can if somebody is first looking into this space, wants to get okay, they've been in the stock market, they're looking at the idea of potentially getting into the syndication space. My whole role is to just simply educate and then connect with operators that I know do really well by their investors, and then present those to my
Yeah, I
investors.
think this is great advice too. Like, you have to decide if this is you want to be, you see this as, oh, I really like, the real estate piece of it, the active participation in managing and modifying a piece of property to for its highest and best use and maximize profit. Is this something that interests you, or for you, you want to basically, this is just an investment, and you want to have a piece here and a piece there and a piece and diversify that way, and continue to do your job and do it that way. So I think there's a component of that, like, this is something that really interests you to do the active management of these projects, and or not, you're just thinking of it as an investment.
Right. And yeah, so as I meet with somebody, as potential investors, and a lot of my investors are business owners, they're doctors and lawyers, and they want the investment upside and the tax benefits of owning real estate, but they have no interest in managing and syndicating. That's a great fit.
Yeah.
And I've got friends in the space who are, they do a lot of land deals, and they do, really creative finance deals in real estate. That's not people I'm going to really spend time pursuing as far as potential investors, because they're close to it. They're active. They love their flipping business. That's not really the type of people that really want to seed control by just placing money in passively into a deal. And so it really is, again, where people's mindset is and their interest levels.
Yeah, exactly. So what is the typical minimum investment that you have for your syndications?
Generally, if we're talking about a single asset, meaning we are all coming together to buy an apartment complex at 123 Elm Street, those type of deals, we see the minimum is generally around $50,000.
Okay.
We also do funds where we have, we're gonna inside of this fund, we're gonna put 10 different apartment complexes across the country into this fund, and each of the investors are going to own a slice of each one of those assets inside of that fund. Those fund levels bring some operational efficiencies and lower legal costs, and so we're able to lower the investment minimums on those. And so so we drop it down to 25,000 for those funds.
Okay. Well, it's very interesting. And that's another advantage as well for someone that that is trying to decide what they want to do. If you have like $300,000 or $400,000, and then the amount of money you have, and you say, well, I want to invest, I want to be the active investor in an apartment building, then that money that you have, the $200,000 or $300,000, is going to constrain, unless you find other partners to help you out. That's going to constrain the type of building that you're going to buy, the size, the location, and maybe the renovation budget if you're going to do like any kind of rehab. So these are all kind of components. But when you're looking at it from a syndication perspective, you have your $200,000 or $300,000. You can go and say, well, I'm going to put $100,000 here, $50,000 here, and now you have a portfolio of assets, and then you're diversifying, and you kind of minimize your risk also on your investment, instead of active participation in one asset and driving that.
Act in that comment about being one asset. You could take that 300, 400,000, go buy a 30-unit apartment complex. A 30-unit apartment complex is going to be the same type of property manager who manages single-family rentals and duplexes. You can't afford on-site management for those type of deals, and so you've got all your eggs in that basket right there. You're going to get those phone calls. You're going to get asked about the toilets and the HVAC, and what about this renter, and what about this sad story about why this guy's late. You're going to get all of that when you're owning a 20-30 unit complex. And so in a syndication where you buddy up with 20 or 30 other investors on this deal, you go buy a much larger asset or a pool of assets. You have the opportunity to diversify and make these deals, these operations quite a bit more sophisticated as well.
Excellent. Well, thank you very much. Thank you for all of this information. If people want to reach out to you, what's the best place for them to reach out to you?
Yeah, the best place to connect and learn more about us, my team, and see the deals that we have available is on our website, sugarhouseinvestments.com. That sugarhouseinvestments.com is where you can sign up for our email list and look at that article that you talked about, stocks versus real estate. But then as far as day-to-day interaction, I actually enjoy spending quite a bit of time on Twitter. There's phenomenal real estate conversations going on there. My handle there is just @BradShep. I'm on there most days. Bantering around on commercial real estate discussions. So happy to connect with them as well.
Okay, great. Well, thank you very much. Thank you, Brad. So make sure you like and subscribe for more of these fantastic interviews, and see you next week.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.